Hello, welcome to the Voice of Democracy podcast. I'm your host, Bruce Carter. In this podcast, you will hear intriguing and thoughtful interviews, as well as actionable tips, strategies that can be implemented either in your institution, health and wellness, and education. Our podcast is not about name recognition or being famous. Everyone has untapped potential. In today's fast-changing landscape demands nation leaders who can quickly adapt, build trust, and deliver value. Through people and technology, we're listening and providing insight on tough political and business challenges, including talent transformation, geopolitical conflicts, pandemics, and social injustice. In this podcast series, Voice of Democracy offers insights to help you tackle today's challenges and prepare for tomorrow. Through social change, we will be the voice of democracy, American promise, global mission. Thanks for spending time with us today. Now, let's jump into your daily dose of Voice of Democracy. Today's highlight will be a continuation of Taxing the U.S. Rich, Part 2, Historical U.S. Tax Rates, Timeline, and Taxing the Rich. This series will be a 4-part series. Part 3, we will focus on tax evasion by millionaires and billionaires and loopholes. Part 4, how do the rich avoid paying taxes and loopholes. I will provide my conclusion recommendations after concluding all 4 series. Again, we will start with today's podcast, Part 2, Historical U.S. Tax Rates, Timeline, and Taxing the Rich. First, let me open by saying, President Franklin D. Roosevelt's New Deal programs forced an increase in taxes to generate needed funds. The Revenue Act of 1935 introduced the wealth tax, a new progressive tax that took up to 75% of the highest incomes, mainly wealthy people who use loopholes in the tax code. The Revenue Act of 1937 cracked down on tax evasion by revising tax laws and regulations. So let's get started. The cost of World War II exceeded federal tax revenues. The Revenue Act of 1942 proposed a victory tax, the broadest and most progressive tax in American history, to ease taxpayers' burden of paying a lump sum from this mass tax and to create a regular flow of revenue into the Treasury. The government required employers to withhold money from employees' paychecks. By the end of the war in 1945, about 90% of American workers submitted income tax forms. According to the public opinion polls, most Americans believe the rich do not pay their fair share of taxes. While these polls do not reveal what the public believes a fair share would be, many pundits and politicians suggest history should be our guide. Since enactment of the individual income tax in 1913, the top rate has ranged from a low of 7% to a high of 94%. Given the top rate is now only 37%, there appears to be plenty of room to go higher, but appearances can be deceiving. The top rate is only one feature of our tax system. By itself, the top rate tells us nothing about the amount of taxes paid by the rich. The high rates that existed in the past did not apply to every type of income, and they only apply to a fraction of total income, thereby providing opportunities for the rich to avoid paying such high rates and mitigating their negative economic impact. Thus, the belief that we soaked the rich before without any adverse effects, so we can do it again, is largely a myth. Ironically, this myth is at odds with another widely held belief that the rich currently pay little or no taxes, which is also largely untrue. This issue brief will review the history of the top rate and examine 4 historical periods: 1910 through 1920s, 1930s, 1960 through the 70s, and 1980s, in which the top rate changed significantly. either up or down. The evidence shows the rich responded to these changes by reporting more income when rates were lower and reporting less income when rates were higher. Aside from engaging in various tax evasion schemes illegally, the rich also engage in tax avoidance schemes legally, such as changing the amount of income they earn or shifting income between the individual and corporate tax systems. Each of these responses has important public policy implications for the debate over income inequality, tax revenue, deficit reduction, and economic growth. Higher marginal rates cause the rich to report less income, thereby reducing the gap between the rich and poor. But the reduction in income inequality is more apparent than the real when income is shifted to the corporate business sector. This shift will determine whether higher rates increase or decrease the amount of revenue available to reduce the deficit. Higher rates also reduce the incentive to work, save, and invest, which will reduce economic growth. As a result, the government will collect less revenue than might otherwise be expected. The magnitude of these effects is uncertain. Thus, the physical implication of taxing the rich are difficult to determine. Nevertheless, policymakers should not ignore these trade-offs. Addressing our nation's long-term physical challenges will require additional revenue, including higher taxes on the rich. Both economic theory and empirical evidence suggest that the best way to achieve that goal is to reduce credits, deductions, exemptions, and exclusions, rather than increase marginal tax rates. For example, policymakers should look to broaden the base and lower the rates. A brief history of the top tax rate. The individual enacted tax was enacted in 1913 following the ratification of the 16th Amendment, which overturned an earlier Supreme Court decision that held the individual income tax was unconstitutional. The corporate income tax, which was enacted in 1909, was considered an indirect tax and thus not subject to the same constitutional challenge. Both the individual and corporate income tax began with the modest top rates of 7% and 1%, respectively. The top individual rate reached a high of 94% in 1944 through 1945. And the top corporate rate reached a high of 53% in 1968 through 1969. However, the top rate has not always applied to every type of income. For example, capital gains, dividends, and earned income tax, such as wages and commissions, have often been taxed at a lower rate. And the interest earned on municipal bonds has generally been tax exempt. The top tax rates are marginal rates. That means that they only apply to the additional income earned above the specific threshold or tax bracket. Income that falls below the top bracket is taxed at lower rates. The number of tax brackets has also varied over time. The combined total amount of taxes paid at each rate within each bracket divided by the total income is the effective rate, which will be discussed later. Pass-through businesses, partnerships, and sole proprietors and S-corps are subject to the individual tax rate, whereas C-corps are subject to the corporate tax rate. Thus, when these rates are different, some taxpayers can choose to report their business's income in a category with a lower rate. To evaluate the effects of the top tax rate on the amount of income reported by the rich, it is necessary to consider the interaction between rates, brackets, credits, deductions, exemptions, and exclusions, as well as distribution of income, and the ability to convert one type of income into another, or category or type, or one type of business as another. Each of these factors affect the amount of taxes paid by the rich, not just the top rate. A detailed assessment of each factor is beyond the scope of this podcast. Nevertheless, the historical evidence indicates the rich respond to lower tax rates by reporting more income, and they respond to a higher tax rate by reporting less income. The change in reported income likely reflects some combination of tax evasion, illegal behavior, and tax avoidance, illegal behavior, depending on the circumstances. These results and their implications will be examined in more detail as I go on. So let's look at the historical timeline. As I mentioned earlier, 1910s through 1920s. When the individual income tax rate was enacted in 1913, the top rate was 7% on income above $500,000. As the United States prepared to enter World War I, Congress increased the top rate to 15% income above $200 million. Correction. The income was above $2 million. My apologies. In 1917, the top rate was increased to 67%. And in 1918, the top rate was increased to 77%, and the threshold was lowered to $1 million. After the war, the top rate was gradually reduced along with the income threshold. From 1925 through 1929, the top rate was 25% on income above $100,000. Let's look at 1930s. Tax policy during the 1930s marked a completed reversal of the policy enacted in late 1920s. In 1932, the top rate was increased to 63% on income above $1 million. In 1936, the top rate was increased to 79% on income above $5 million. This reversal of policy did not change the direction of the results. Higher marginal rates resulted in less reported income. The perception decline in income, as well as the corresponding lack of additional revenue, drew attention of policymakers. In 1937, Congress established a Joint Committee on Tax Evasion and Avoidance in response to a letter from President Franklin Roosevelt that stated in part, "The Secretary of Treasury has given me a report that reveals efforts of avoidance and evasion of tax liability so widespread and so amazing in their boldness and their ingenuity that further action without delay seems imperative. I'm confident that the Congress will wish to enact legislation at this session specifically and exclusive aimed at making the present tax structure evasion proof," quote unquote. The Joint Committee held a series of hearings focused on numerous schemes used by the rich to avoid paying higher taxes, including individual use of the corporate business structure. Despite congressional efforts to eliminate these schemes, they continue to proliferate. A more recent article during that time was the LA Times explained how celebrities in the 1940s and 1950s converted their salaries into capital gains using a collapsible corporation. Such schemes persisted into the 1980s. The inclination of pundits and politicians to describe these schemes as tax evasion and avoidance is understandable. However, the evidence suggests that the rich were more likely to be shifting taxes rather than avoiding them entirely. There has typically been a significant difference between the top individual rate and the top corporate rate. The greater the difference between these two rates, the greater the incentive to report more income at the lower rate and less income at the higher rate. Okay, so let's look at 1960 through 1970s. Between 1936 and 1963, the top individual income tax rate generally ranged between 80 and 90%. In 1964, the top rate was reduced to 77%, and it was reduced to 70% in 1965. These rate reductions were partially offset by a temporary tax increase from 1968 to 1970, which was followed by an effort to limit the top rate on earned income, such as wages and commissions, to 60% in 1971 and 50% thereafter. Although the limit was largely ineffective, it did reduce the top marginal rate the top marginal tax rate for about 1/3 of the taxpayer who would have otherwise paid more than 50%. Now let's jump to the 1980s. In the 1980s, the top tax rate was reduced from 7% to 50% and then to 28%. These reductions was partially offset by the increase in the top rate on capital gains from 20% to 28%. Because capital gains are only taxed when assets are sold, taxpayers can choose when to sell their assets to take advantage of lower rates or avoid higher rates. Because capital gains were such a large component of income during this period, the relationship between marginal tax rate and adjusted gross income, both and without capital gains as a percentage of the gross domestic product, which is known as GDP, used in the same methodology during previous years. Taxpayers increased capital gains on realizations in 1986 to avoid paying the higher rate that took effect in 1987. Excluding capital gains, the same pattern emerges as before. The amount of other income reported by the rich increased in response to lower marginal tax rates. So the rich pay more than little or nothing, as the cliche goes. Public support for higher taxes on the rich is primarily motivated by the belief that the rich do not pay their fair share. It is not clear what the public believes a fair share would be because the polls either don't ask that question or else they fail to distinguish between the marginal tax rate and the effective tax rates. That's a critical oversight. Even if the public believes millionaires should pay a 7% tax rate on each additional dollar they earn above $1 million, that reveals nothing about how much the public believes millionaires should pay on their total income. Many people believe the rich don't pay any taxes. This belief is not entirely without some justification. According to the IRS, there were nearly 29,000 taxpayers with income over $200,000 in 2020 who paid an effective tax rate of 0 or less. Because the United States taxes the worldwide income of U.S. citizens, with some exceptions, but allows credit or deduction for taxes paid on other countries, the number of taxpayers with income over $200,000 who paid 0 or less on a worldwide basis was roughly 9,000. Overall, 37% of all taxpayers paid no income taxes, including 62% of taxpayers who earned less than $50,000. The single biggest reason some higher income individuals pay no taxes is due to the interest they receive on tax-exempt municipal bonds, which increases their income, but not their taxes. These bonds are typically issued by state and local governments to finance construction projects like roads and schools. The federal tax exemption allows states and localities to pay a lower interest rate, thereby subsidizing the costs of these projects. According to the U.S. Treasury, this exemption reduces federal revenue by roughly $50 billion a year. Even among the rich who pay taxes, there is a widely held belief they pay less than the middle class. Again, there is some justification for this belief. According to the IRS, the median taxpayer paid an effective income tax rate between 0 and 5% in 2020. The median is the point at which half paid more and half paid less. Among the 9.6 million taxpayers with income above $200,000, roughly $70,000 paid less than 5%. Although the top marginal tax rate is currently 37%, the effective tax rate is almost always less. In part because lower rates apply to income that falls within the lower tax brackets, but also because the tax rate on political gains and dividends is less than the top rate on other income. The rationale of these lower rates is discussed. I will discuss below. Although some higher income taxpayers pay little or no taxes, the richest taxpayer typically pay considerable more. According to a congressional budget, the CBO, The top 1% of the households paid, on average, the effective tax rate of 22% between 1979 and 2020. That compared to an average effective tax rate of 5% paid on households in the middle 20% of the income distribution. Assuming public support for higher taxes on the rich is based on the mistaken belief that they pay little or no taxes, then the proper course of action is to educate the public, seek consensus on what constitutes a fair share, and propose options to achieve that goal. These options will presumably focus on those who pay little or no taxes, and the reason for this, rather than those who already pay considerable more. So briefly, let's talk about double taxation and the economy. As noted above, some types of income are subject to a lower tax rate than others. The justification for a lower rate is based on the desire to reduce or eliminate the double taxation of savings. This double taxation occurs when income is taxed and any after-tax income that is saved is taxed again. The additional tax on saving reduces savings and investments, ultimately resulting in a less productive economy. The case against the double taxation of savings can be explained in terms of time value of money, which is a rate at which people are willing to forego current consumption in exchange to future consumption. This rate can be viewed as a discount rate in a present value calculation, or the expected rate of return on investment, assuming these rates are the same. Whenever a tax is imposed on the income derived from savings, such as interest, dividends, or capital gains, people will not receive the present value of the original amount they initially invested. For example, if people exchange current for the future consumption at a rate of 10%, then $1 invested today will equal 1.10 1 year later, or in the present value terms, 1.10 received in a year is equal to $1 today. Assuming a marginal tax rate of the 25%, $1 invested today will have a present value of 0.977. 1 year later, $1 plus 0.10 times 1.25% divided by 1 plus 10%. Thus, a tax on the income derived from savings can be viewed as a double tax on savings because investors do not receive the present value of their initial investment. The double taxation of savings affects the economy by increasing the cost of investing in capital assets, such as factories and machines and intellectual property. The cost of capital or service price is the gross return that additional unit of capital must earn to cover the costs associated with its use. The costs including economic depreciation due to wear and tear on technology, obsoletes, taxes or businesses and investors, and a normal rate of return which affects the time value of money. In the short run, taxes increase the cost of capital and decrease the after-tax rate of return, resulting in less investment. The historical evidence suggests businesses and investors forego the least profitable investment until the amount of capital shrinks enough to restore a normal after-tax rate of return. Thus, in long run, taxes on capital do not reduce the after-tax rate of return. Instead, they reduce the amount of capital relative to the size of the economy. Despite the uncertainty surrounding the magnitude of the response, the regression results highlight the potential trade-off between taxing the rich and growing the economy. Decreasing marginal rates will expand the economy by increasing the supply of labor and capital, whereas increase in the marginal tax rate will have the offsite effect. As I stated before, I will provide my conclusion and my recommendations towards the end, and when I finish the series 4. So, as we close, this podcast is brought to you by the People First Consulting Voice of Democracy. For more information about the People First Consulting Voice of Democracy, please visit our website at www.pfcworks.com. Remember, this is a 4-part series on taxing the rich. Stay tuned for part 3. American Promise, Global Mission. Thank you for tuning in and listening today. Until next time, please be safe, vote, stay informed, and live well.